JM Financial Mutual Fund's fixed income outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. During the month, 10-year global benchmark yields moved upwards, with US Treasury closing at 4.57%, up 46 basis points, Germany at 2.84%, up 37 basis points, and Japan at 0.76%, up 11 basis points. Brent crude oil, which is a major driver of yields, moved up from US dollar 86.86 per billion barrel to US dollar 95.31 per billion barrels, which is a rise of about 10% during the month. This rise was due to both supply-side constraints, such as continued oil production cuts by Saudi Arabia, and demand pull inflation, where growth is surprising on the upside. US growth projections by the Federal Reserve were revised materially upwards from a median of 1% in June's projections to 2.1% in September's projection for 2023. As per Bloomberg, probability of a recession in the next 1 year has also come down to 55%, from 65% in January 2023. Whereas in the UK, probability of recession has been revised downwards to 60% from 90% in January 2023. Dwelling deeper into the US growth surprise, one of the drivers of growth may have been that interest rate increases have been passed on to the end consumer with a greater lag in advanced economies compared with emerging market economies. This is evident through the charts here taken from Bureau of India Standards Quarterly Review Report for September 2023. Advanced economy banks are having lower share of business loans, which have typically floating rates, and lower share of short-term loans less than 1 year compared to emerging market banks. Mortgage loans form majority of advanced economy banks' balance sheets, which are likely to have been lent for longer-term maturities at fixed rates of interest. The data indicates that in an environment where, although interest rates have risen substantially in the US, the net interest income has actually risen for the average borrower. The data indicates that in an environment where, although interest rates have risen substantially in the US, the net interest income has actually risen for an average borrower. This is because the investment surplus kept in money market funds or bank deposits are resulting in higher income versus long-term borrowings taken at lower interest rates. This has contributed to the resilience of the US economy, which reflects in the Fed revising US GDP estimate for 2023. Coming to the domestic markets, bond yields at the longer end moved up, tracking global bond market movements and the strengthening dollar index. Rising crude price also added to the worries on increased upside risks to inflation. Despite the good news of inclusion of Indian bonds in the GBI-EM Global Index, yields at the longer end of the curve inched up due to an unfavorable macroeconomic environment. The 10-year GSEC traded in a band of 7.1 to 7.28% and closed at 7.21% in September 2023 compared to 7.13% in August 2023. On the inflation side, headline CPI inflation for August 2023 printed at 6.83%, lower than the previous month's reading of 7.44% on a year-on-year basis. CPI inflation remained above the RBI's upper tolerance band for the second consecutive month. Moderation in food and beverages inflation to 9.19% in August 2023 from 10.57% in July 2023 supported the softening in headline inflation. On the positive side, core inflation further moderated to 4.79% in August 2023 from 4.94% in July 2023. Continued softening in core inflation is likely to provide headroom to the policymakers to look through the seasonal spike in vegetables. Liquidity conditions remained tight during the month of September 2023. Liquidity slipped into deficit in the second half of the month, largely due to tax outflows. Daily average borrowing through the marginal standing facility window increased to Rs 942 billion in September 2023 from Rs 347 billion in the previous month. Credit growth in August 2023 stood at 19.8%. As on September 8, 2023, marginally higher than 19.7% as on August 11, 2023. Credit growth was led by personal loans, service, agriculture and industry in that order, with year-on-year growth of 30.8%, 24.7%, 16.6% and 6.7% respectively in August 2023. Deposit growth stood at 13.6% as on September 08, 2023, with a marginal uptick over the previous month. The domestic bond inclusion in JP Morgan's GBI EM Global Index could be a major milestone in India's financial history. This may not only lower the cost of borrowing for the government, but may also ensure in pulling down the cost of capital for all asset classes, leading to easier funding and better liability structures for the domestic economy. However, fundamentals are likely to continue to drive the bond markets, which would be a mix of global yields, currencies, commodities, inflation, fiscal deficit, etc. Central banks of most major economies continue to be watchful with a hawkish bias at the margin. Interest rates continue to be higher for longer, and at the margin, liquidity continues to drift lower. We remain cautious and have positioned lighter on duration across our funds, reflecting our readings of macros. We see risk from a higher Brent, El Nino and its impact on inflation, strengthening dollar and its impact on rupee, as well as demand-supply mismatch in the US as it continues on the path of higher supply of sovereign securities due to high fiscal deficit with lesser demand for the same as the Fed is in a quantitative tightening mode versus a quantitative easing mode as in the past. And appetite for foreign banks for US securities seems to have become lower. On the other hand, yields can be capped due to factors like inclusion in the global bond indices, positive real rate environment coupled with softening core inflation and relatively balanced demand-supply dynamics in the second half of the year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.